So we're going to talk about private credit. I know it's probably come up a little bit just looking at the agenda. And it was funny, I had a chance to have Elisa Wood, one of the previous conversations, on my radio show before I came down here. And the conversation, not surprisingly, given KKR's earnings results today and their discussions of private credit, it came up there as well. So a lot to dig into. I would want to get a sense from these guys a little bit of how we got here, because I think if we were all talking 10 years ago, or certainly 15 years ago, this would be much more niche, and yet here we are, and it is a massive, massive business. So Drew, I want to start with you because you sit in sort of LP land. You see all these allocations. How do we get here? What was the catalyst for this?
Yeah, and just to level set for everybody, so Hamilton Lane manages over $450 billion of nothing but private market capital. A sizable portion is in private credit. How we got here, there's been an evolution that's happened. I'll spend less time on the bank retrenchment trend. I think Elisa hit on that a little bit earlier. That's more on the supply side. But I think what's also happened concurrent with that is the evolution on the investor and limited partner side. And so you have them living in an environment where they're traditional public fixed income, they've been yield starved. And then when you think about private credit, not only is the opportunity set massive, and you've had that sort of supply side shift, but it's the characteristics of credit for the investor that are just different from other parts of the private market portfolio. So very different than your private equity exposures in terms of consistent cash yield, lower risk given you're investing in more senior parts of the capital structure, and importantly, just shorter duration. So I think all of those things have fueled demand from the investor side, and we expect that's likely to continue.
All right, so Jim, come on in here, because when a lot of people think about Ares, there's a great profile written by a couple of my colleagues just a couple of weeks ago, maybe even last week. I lose track of time in this sort of market. About Ares, and a lot of it focused on the private credit direct lending business. You guys were early on. What did you see? How did you sort of identify this opportunity?
Well, first, I wish I could say that we were thoughtful enough to predict this is where things were going to go, but
just take credit.
Yeah, I probably should.
Pun intended.
And in fact, actually, there was a point in time where being under the radar was actually really nice, and we had an industry. I think you go back, it hasn't really changed all that much from the fundamental perspective, where it's a nice, safe asset class with great relative value. I think in the last few years, it's just been exposed. People have identified it and seen it. The private equity market, as we've heard, has obviously expanded meaningfully, and we're just a subset of that, a function of that. But in the last few years in particular, I think there has been a transition in the GP-LP relationship and who's funding this market. And what I think has really happened in the last couple of years in particular is the liquid market, which has been around and a big part of LBOs, is converting into private capital. That transition fundamentally is what's driving, I think, the latest growth and evolution in our business.
All right, so Chrystalle, you mentioned as we were getting ready for this that you guys have done some work, I think a survey about kind of where money is going. So take us inside that, kind of bring us up to the present, and if not to give away the punchline, but a different market even from last year to this year in terms of how people are thinking about it.
Right. So just for context, Eaton Partners raises capital exclusively for alternative investments. Depending on the day, we're the #1 or #2 placement agent in the business. So our focus is exclusively on constantly talking to investors to understand where they're focused and on covering the markets. And so I co-head our private credit practice. I'm on the research side of our firm, and my job is to have a view on what parts of private credit are interesting at any given moment in time, and to understand who are the players in those spaces. Our investor coverage team is responsible for talking to the investors in their regions and listening to them and where they're focused. So we've just completed this exercise of speaking with our top credit investors, those who are most active in allocating to private credit, and the results were really interesting. So last year when we did this exercise, the number one thing people were telling us they were looking for was middle market direct lending. Now, about 2/3 of investors are saying they're still looking at that space. We heard a little bit more about people getting a little nervous about the amount of capital that's been raised specifically for sponsor-backed private credit strategies. And things that they're looking at now, over 90% of the respondents told us they're looking at asset-based credit. So that tells us a couple things. One, people are looking for some real tangible collateral. They might not be sure, going back to Henry Cornell's point earlier today, whether we're in the 7th inning, the 9th inning, whether it's a cricket match and it's going to go on for days. But either way, there would be a little bit more comfort if they weren't dependent on cash flow-based loans, but instead some hard assets that they can look to.
All right, Milwood, come on in.
I'm here.
You've heard the backstory. You've heard the current. Take us inside. What you're doing, how you're seeing the market, given this obviously robust appetite for this asset class.
I think in Oaktree, our DNA is to sort of proceed with caution, as Howard said, and I think what we're really trying to do is stay higher up in the capital structure. To your point on assets, is make sure we're attaching at a level that allows us to control our destiny and not be whipsawed by the market. Just given definitions and documentation, it's hard to really decipher what the long-term run rate of a business is today. So I think we want to be higher up. We want to be lean. We want to be liquid. We want to be able to adapt to a market that seems to be quite volatile.
All right, so let's talk returns, because competition breeds
Sure.
lower returns often, right?
Sure.
You got to pay up. So how do you feel about that? How's that looking for you?
Look, I think at Oaktree, and for context for everyone, we manage a little over $100 billion. Our DNA tends to be more of a distressed, or what I would say more of an analytical bottoms-up approach to investing. And so what we rather do is not spend a lot of time in the middle of the fairway. It's pretty crowded. But for those who are golf fans out there, if we're just on the fringe, good lie, there's less crowd there. And what we can do is structure deals and control the documentation a little bit more. We can actually do more diligence and actually know the risk that we're actually buying. I think today, the risk isn't being priced. The availability of capital is what everyone's pricing. So you're not pricing risk anymore. And I think we want to stay focused on pricing risk.
Is there some sort of sports metaphor bingo game that I missed before I got here that's like people in the crowd are going to jump up?
If I had been in South Carolina 3 days ago, I wouldn't be on this panel.
Yeah, there you go. All right, so with all that money that is swirling around out there, I have to think, and I think you all probably have some view on this, manager selection becomes more important and maybe a little more complicated. Jim, let me start with you, because as one of the incumbent players, how do you differentiate yourself in a market like this?
Yeah, sure. Well, for having the benefit of a little bit of scale after 15 years, we actually get a pretty good lens into a broader subset of the markets. Private credit is not just one market. There's lower end of the market, there's upper end of the market, there's senior debt, there's junior debt, there's unitranche, and there's actually different competitive dynamics that exist in each of those areas. What we're finding right now is the lower end of the market is where a lot of the new capital and new entrants are competing, and it's become a bit more hyper-competitive and where returns are most compressed.
Help us understand lower end of the market as you define it.
Hard to say, but probably sub 20 million of EBITDA. I mean, if you think about managers that where capital has formed, it's really formed in two primary places. Smaller players, billion-dollar participants or less, and larger players aggregating capital. And that bifurcation has changed the competitive landscape in the lower end of the market much more meaningfully than in the core part of the middle market. What other part I'll say is, not every deal is a great private credit deal. So there's great executions in a public syndication that are fantastic, and there's sometimes where it just doesn't make sense to do a public deal. And you can generate great returns and have great relative value, but you need a lot of swings of the bat, and you need a lot of looks. And so our objective is to see as many opportunities across the spectrum so that we can try and be selective and not pick any one market or any one asset class at any given time. And they do move, but they don't move together.
Right.
And sometimes months or weeks at a time where things can change.
So Drew, back to you. That manager selection, you've got a whole sea of opportunity ahead of you. You got a lot of, call them anxious, call them enthusiastic, whatever you want, LPs who want to get some money to work. How are you seeing managers make their case, and what advice do you give here?
Yeah, no, I think manager selection is critical. I want to get to that part, but I want to start with the first part of what you asked, which is the growth. And yes, there's been a lot of growth. There's going to be winners and losers in terms of the managers, just like any other asset class, but put the growth in the context. So if there's about $150 billion or so of origination-oriented dry powder, which is basically loans to new performing healthy company, there's just a ton of white space if you compare that to the context of a $1 trillion leveraged loan market, a $1.5 trillion high yield market, or if you think about it from the perspective of the equity managers, they're going to need over $1 trillion of capital to finance the debt portions of the capital structure. So yes, there's been a lot of capital raised, but I think you got to put that growth in the context, and our view is still, despite that growth, there's a lot of white space, so everyone needs to take a deep breath. The growth is normal. The asset class is nascent. It's maturing. And you still need to be careful, just to get to your question on the manager selection. But Jim,
before you get to that,
yeah?
Are you saying that people are getting overly worried about something that's happening in the market? That is weird.
I would point people to the early and mid-2000s, what people were saying about private equity. They were saying the exact same things. There's been way too much capital. This is going to end badly. It's a bubble that's going to pop. Looking back, we all know that's not the case. You were just seeing a natural maturing of an asset class that was long-term oriented, that was here to stay. And to Jim's point, there's not sort of just one bite of private credit. There's secondary distressed credit, there's performing, and then within performing, there's different parts of the capital structure you can attack. So again, I think there's good reasons for the growth. Manager selection is going to be critical. Yeah. Some of the managers that are around today aren't going to be around in 4 or 5 years from now. But again, I think it's all sort of very positive given what's happened in terms of the massive opportunity set that's been.
All right, so now I'll actually let you answer the manager selection question. So tell me the answer to that.
I think you have to think about all the things you would normally think about. The returns definitely need to be there, but it's managers who aren't just kind of putting a fund together out of nowhere. They have a real diligenceable track record. You understand their differentiation, whether that's by geography, by strategy, and how they stack up to other competitors. And I think if you drill down to the asset level, you'll be able to see which managers have been able to generate consistent performance, invest in capital structures that have shown financial wherewithal through cycles. Because in this asset class, it's not about picking winners, it's about avoiding losers. And I think that's no different in manager selection.
And I would just add on to that, and it's certainly consistent with what we're hearing from investors. Regardless of asset class, when they're selecting a manager, they're looking at the team. Have they invested successfully together in the past? They're looking at the track record. They're looking at the other institutions who are backing that manager as a sign of validation that other people who know this manager believe in them. But what we're hearing even more today, especially in private credit, is that people are looking for operators. So that's a term that used to historically only be associated with private equity. But to your point about all the capital that's been raised, the capital is now a commodity.
Yep. It's not that much capital. Drew told me it's not that much capital. I don't even know what you're talking about, Crystal. It's not that much.
But when capital is a commodity, that means that if that's all you have, then you have no choice but to compete on price or to compete on weaker covenants. So we raised capital for a direct lending strategy focused on the agribusiness sector. So think business services for agriculture. And we asked the borrowers, why did you partner with this manager? And they told us over and over again, their capital was not the cheapest, but they get my business. And they can help me grow my business. So they're looking for that partnership, and the investors themselves are seeing that that's where value is being created, and that's where missteps are being avoided.
So does that change the way that you sort of manage your fund, your personnel, that sort of thing? I want to get to a broader talent discussion in a bit, but on that, I want you to pick up on that specific point, if you can, in terms of how you frame your offering, as it were.
So I think in this is an intellectual capital business. capital, to your point, is very much the commodity. And I think when we look at companies and situations, the other side of the table was saying, hey, do I really want to spend my time with that person, right? Because it's no longer about the money. Everyone's got money. I don't know anybody who doesn't have money today. But it's more about what's the relationship going to be like. And in the volatile times or in times, or can I even just have a conversation with it? So the relationship matters today. And I think that's underestimated in our business. The other thing I'll tell you is that a lot of what's driving this is the regional banks, the deposits within these local regions, whether it's Texas or California. There's a lot of money sitting in banks that they're also in middle market a lot more. And so that's also creating the sort of squeeze, if you will, within private credit.
All right, so Jim, let's go inside the portfolio a little bit. Help us understand, all of you have interesting windows, and I'm going to pose this to Milwood in a second as well. You're lending to all these different companies. We're all investors in this room. What's the economy like from the view of someone who gets that intimate look into so many industries and so many types of companies?
We invest in about 1,500 companies across the mid-market today, and the overwhelming theme is positive. And we've heard a lot of the similar sentiment across the panels, but in the mid-market, I would agree. It's the numbers are showing up, the margins are healthy, and overall performance has been very good. So at this particular moment in time, there isn't any one or two or three things that we can identify as real challenges that we're looking at right now. So generally pretty good.
Milwood, what do you think? What do you see?
I think, and I would agree with you, Jim, I think within Oaktree, we've got the benefit of having private equity strategy, distress, regular way. So we see a host of companies, both in public and private markets. And I think what we're trying to figure out is not the trend today, but what happens tomorrow. Like, can you see around the corner? Because me seeing right in front of myself isn't really that helpful to anyone, especially my investors. But how do I see around the corner? What's the impact of new tax laws within our portfolio companies? What happens if there's no resolution of China trade? The sensitivity on your companies and your portfolios is what we're probably focused on today, so that we can react today to what we think will be a trend tomorrow.
And so economically, Drew, given this backdrop that these managers have given, does the appetite for private credit from an LP perspective, does it ebb and flow based on the underlying economy, or is it robust and maybe some changes on the margins regardless?
Yeah, I think that if you look at it, that's the entire private market. So sometimes you have LPs that just tighten up in terms of allocation decisions when the market takes a little bit of a turn. But the one thing we haven't talked a whole lot about is just risk. And returns are one thing. You kind of ask where returns are going to be. But the other huge reason that your series seems to know the answer. The other reason you come in is risk. And if you look at data, which we have a lot of going back 30 years, in a rising interest rate environment or coming through a downturn, you want to be in more senior parts of the capital structure. The private credit space has had the most resilient returns over other asset strategies within the private markets in those types of environments. And so I have no idea when the next downturn's coming. I don't think anyone does. Everyone's thought it's been late cycle for the last 4 or 5 years. At some point, we're going to be correct with that. And it's not going to go on forever. But if you look at the data and the returns analysis, private credit is precisely the spot to be because of its resiliency, because you have it's an inefficient market as well. And so you have better access to information, differentiated access to information, where there's going to be ebbs and flows, as you said, between the borrower and the lender. But if your absolute kind of lowest cost of capital isn't the sole factor for your lending decision, if you value speed, you value certainty as a borrower, you value groups that understand complexity, that is why I think you see structures and the asset class perform as well as it does going in and heading through a downturn.
So, Chrystalle, that sounds to me like investment in this area or money going to this area may only accelerate if the market gets a little choppier or much less if we actually go into something resembling a recession anytime soon.
I think that's right, and that's what we're seeing as well. So if we had had this conversation 10 years ago, we would have said that credit allocations were opportunistic and tactical, and now they're much more part of a strategic asset allocation plan. So we did some analysis on this over the summer, and we found that now 30% of U.S. investors have carved out private credit as a standalone part of their portfolio, which is meaningful. And it's only continuing to grow as more consultants get behind this strategy. There are spaces that do make more sense tactically. Distress for influence is one that comes to mind. So we think of distress for control as more of a private equity play,
right,
where you're really taking over as operators and creating value. Distress for influence, we think, is a very interesting private credit strategy. There are ways to approach it, especially those where you only draw capital as the opportunity presents itself. We think that's a smart way for investors to make sure that they're well positioned when the market moves and then quickly snaps back. But there are other parts of the market that really make more sense as evergreen allocations.
I have to say, the cynical part of me, and maybe the journalistic part of me, loves the idea of distress for influence. It's like, no, it's not distress for control. It's just distress for influence. I just want to give you my opinion sometimes. It's fine. It's fine. Yeah, don't worry. It's just distress for influence.
I won't take the keys.
Yeah, exactly. So Jim, let's talk about that. I don't need you to weigh in on my bad joke, but what, how does it change? If only because 30%, that's a lot. But what that says to me is 70% don't. And so having been in this market for a while, Jim, do you see that changing, that more LPs are going to, do your investors, potential new money, are they starting to carve out a specific bucket for this? How do they look at this asset class?
Firstly, it wasn't an asset class by definition in most of the LP community. It was, if anything, a subset of the alter private equity segment. Private credit now is actually a defined term in many institutions, which didn't exist a few years ago, which tells you something. But I think our experience is that some of the capital inflow is slowing, that there is an observation that there is a lot of capital that has moved into the market. Deployment is actually a bigger challenge at this point for a lot of managers, especially new managers. The only way to deploy is to buy market share. And so I think with lower levels of deployment relative to expectations in the community, there's going to be a slowdown of capital flowing in until that deployment catches up to what's been allocated to those baskets.
Weigh in on that. Weigh in on the opportunity set going forward.
There's a theoretical answer, and then there's the practical answer.
Yeah.
Right? The theoretical answer is we all want to say, when the market dislocates, I can deploy capital, I can take risks, I can jump in.
Yeah.
The practical answer is, when it happens, you're saying, oh, I don't know if that's the bottom. I don't know if I really want to do this yet. I'm going to lose money, and so no one does anything, right? And so what we try to do within Oaktree is not be emotional about situations. These are assets, right? You don't fall in love with assets, right? And so when the market does dislocate, the interesting opportunities, you can then price risk again, right? And that's what you want to be able to do, is price risk and not price the commoditization of capital. And so I think we will, when the market dislocates, is then deploy, and I think within Oaktree we have a distress fund and a lot of money ready for that, and that's our DNA, is to deploy capital when there's uncertainty and you aren't sure when to deploy it.
Right. So one of the things that we've been dancing around a little bit is this idea of, in this fast-growing market, you guys are all very senior in your firms. Are you finding the people to do this work? We talked about operators earlier. Are these essentially like private equity guys you got to retrain to think about credit? They got to get smarter on Excel. They got to understand, parts of the income statement and the balance sheet that they didn't before. Are the business schools teaching this? I'm asking this quasi-seriously in the sense of, can you get the people that you need at this point, Jim?
Well, our success comes from hiring at the youngest levels and training. because there is a shortage of talent, certainly at the most senior levels. And there are a lot of, with all the new entrants, there are people who have reinvented careers into private credit.
Yeah.
So the true level of experience is not where it needs to be.
Right.
The manager selection part of that is a big part of the equation. I can tell you from our experience, we have the most luck when we train, we develop, and they stay for a long period of time. And so managing turnover is something that we focus on immensely because it's too critical to have all of that training go away.
Right.
So it's a really important part of what's going on right now. And lack of experience, in our view, is a big driver for terms, documents, things like that.
Right.
Just not awareness, especially if you come from the high yield market and try to translate that into a $30 million EBITDA company. It's not the same thing.
Right. The unfortunate, since 2009, everyone's been a genius, right? Because the market's only gone up.
Right.
So the real question on personnel is, does that individual fit the culture?
Right.
And I think we spend a lot of time on analyzing and evaluating individuals for fit and culture, because I think the tools of modeling, diligence, it's very different today than it was when I started post-grad school. The processes and diligence are so quick, because now the challenge is deployment, as you said earlier. Everyone wants to do a deal.
Right.
And so if everyone wants to do a deal, no one does any work to do the deal.
Right.
So, because everybody wants to do the deal. Sorry.
But the deals are critical.
Yeah.
And that's where we're finding investors are focused.
Yeah.
So with over 4,000 funds on the road trying to raise over $1.5 trillion of capital, and 400 of them being private credit funds, you are not real in these investors' eyes until you have a deal. Have you done deals in the fund? And getting back to Drew's point earlier about how did we get here, it's really because investors lost a little confidence in that blind pool fund structure.
Yeah,
So
great point.
and also had some concerns about J-curve. So buying into a pre-seeded fund helps solve a lot of those issues, and it also helps remove some of the questions about, is this manager truly talented?
Right.
You can see how they think and how they source.
So pick up on that, Drew,
Yeah.
if you will, because that reminds me of what you said earlier about this is private equity, mid-90s don't remind me. If
Just
I'm
in terms of the
quoting.
growth profile.
Just in terms of the growth. But from a talent perspective, too, I would imagine that's true from a track record perspective, because if you think back to that period of private equity, maybe I'm showing my age a little bit, but there weren't a lot of people running around with great track records then in that asset class. So is this a temporary phenomenon, or is this, maybe a more sensible way of gauging someone's track record here, preceding that is?
Yeah, I think that there's definitely, without question, you need to have a different disposition if you're underwriting equity and coming from that orientation with rose-colored glasses versus the downside-focused, how do I lose money, Grinch at the holiday party mindset that I feel like there are a lot of credit investors, the way they think about investing. And so absolutely.
I don't think either of you are Grinchy, by the way. You seem very friendly. Go on.
Comfortable with it.
And so I think that there's going to continue to need to be evolution of talent within the space, and the shops that have been successful oftentimes in terms of newer entrants, it is hard to differentiate because everyone's looked very good over the last 5-7 years, are the shops that have real cultural DNA that has a deeper root in credit, even if some of the younger talent is newer, that there are some core members of those teams that have been around, that have relationships, that have differentiated access or strategies to approaching credit.
All right, so we've only got a few minutes left. Everybody's thirsty. So let me end with this and give you each sort of a chance to do this. What's your biggest hope and what's your biggest fear over the next year in the private credit markets? Chrystalle, I'm starting with you. So there's no bias toward one end or the other. I'm just going.
Well, my biggest hope is that investors continue their interest level in private credit, because I think that 30% is probably too low a number for a strategic asset allocation. It probably makes more sense to be closer to 50 or 60. There are some that need to just consistently be focused on higher octane strategies, but for others, it makes a lot of sense, again, to Drew's point about risk profile, to be a little bit more balanced. And my biggest concern is that people focus too much on the strategies right in front of their face and not see the full ecosystem of credit, because there's a lot of interesting opportunities, many of which we haven't even had a chance to talk about today.
All right, Jim, I'm going to go to you, and I should have told you at the beginning you cannot say the same thing as someone else. So,
Look, I think there's a lot of similarities across the panels. We're all hopeful for some level of dislocation, some level of market turn. I mean, the deployment issue, to flush out some of the challenges, I think that's all people are waiting for. The concern is it's too aggressive, it turns too quickly, and leads to a whole lot of problems in the portfolio overwhelmingly, so you can't jump in, and there's too much anxiety around it for a prolonged period of time, because I don't think anybody really wants that. But they go hand in hand, and I think if ideally we have a correction, we have a market dislocation, but it's not too severe.
it corrects just enough.
Just a little.
Just enough to make a lot of money.
Yes, exactly.
All right, Milwood.
Well, you said we couldn't say the same thing.
Well,
Because my hope and fear were volatility on both sides.
I was going to say volatility for both
But
answers.
yeah, so at least we're consistent.
There you go.
And we never rehearse.
Think up
I think my hope is that investors, managers really take time to ensure that you're focused on doing the right deals for whatever it is your strategy is. I think doing the right deal and getting it right is a lot more important than how many you do, because no investor is going to care about the 10 deals you got right, but they will care about the one you got wrong.
Interesting.
And so as Howard
And is the risk higher there in credit than it is in private equity?
I think in private credit it's a lot higher, because think about it, in a lot of our deals that we do, we may be the single lender.
Yeah.
If it goes bad, our investor base
That's
will
on
say,
you.
well, wow, were you really that smart?
Yeah.
Right?
Yeah.
In the public market, I can be in a deal with 200 investors, so I can kind of hide. In private, you can't hide.
Right. That's really interesting.
And so that's probably on the hope side. On the fear side, I think continued complacency around asset selection, manager selection, people selection. When it only goes one way, you tend to be more complacent. I think that's my fear.
All right. True, last word.
I was going
put you in a tough
volatility
Yeah,
on
yeah.
both, the hope and the fear, because I think it would help to have a little bit more choppiness and help the deployment issue. You worry about the tail risk. I guess I'll expand upon the point that he just made, which is loss ratios in private equity on average are about 20%. That stat surprises most people, and returns overall are still good and outperform. But you're, as an investor, willing to accept in a portfolio of 20 companies in a buyout fund, 4 or 5 are going to be impaired in some way. If you have a credit fund and you're a manager and you have that same portfolio and you have a loss ratio of 5%, you're getting really beat up. And so I think that
Less
is
room for error.
much less room for error, going back to the focus on downside protection, the focus on risk protection, the focus on credit quality and assets. And I guess last thing I'd say is just my hope is that when we look back on this asset class as it's continued to evolve, and it is evolving, meaning there's going to be good changes, bad changes, good managers, bad managers, that it'll be the long-term asset class I think we expect that it is likely to continue to become.